Nobody's saying this out loud, but something just broke inside the silver market, and it didn't break the way it was supposed to. A drop was expected. A controlled move lower, almost engineered. And yet, right now, silver didn't collapse. It snapped back violently toward 82s. This is not just volatility. This is resistance. And if you're watching this before Monday opens, don't ignore this. Because what just happened may change how this entire market behaves next. So before you scroll, subscribe to the channel, like this video, and comment what you think is really going on. Because what you're about to hear, most people are not connecting yet. Let's slow this down, because the official story is simple. They will tell you the US dollar weakened, so silver moved higher. And that is partially true. When the dollar falls, commodities like silver often rise because they become cheaper globally, but that explanation is surface level. Because at the same time, something else was happening underneath. Just today, silver jumped around 4.6%, touching near $82 levels. That kind of move in this environment is not random, because we are not in a low volatility phase anymore. We are in a stressed system. Now look deeper. At the same time this price action was happening, India, one of the largest physical silver buyers in the world, literally froze imports. Banks stopped orders. Shipments got stuck. More than 8 tons of silver sitting at customs. Think about that. A market already tight on supply suddenly loses a major import flow. And here's where it gets even more interesting. This wasn't due to demand falling. It was due to policy delay, a regulatory issue, the kind of disruption that creates temporary shocks in liquidity. And liquidity is everything in markets, because here's what institutions understand. Liquidity is the ability to move markets without resistance. When liquidity dries up, even small pressure can cause big reactions. Now connect this to something bigger. Global silver supply has been under pressure for years. According to industry research, 2026 is expected to be the 6th consecutive year of deficit. And since 2021, over 760 million ounces have already been pulled out of available stock. That's not speculation. That's physical drawdown. So now you have 3 forces colliding. A structural supply shortage, a temporary supply disruption from India, and a market that just attempted to move lower, but failed. This is where you need to pay attention. Because historically, when a market refuses to fall, despite pressure, it often means underlying demand is stronger than expected. Not visible demand, but hidden demand. And no, this doesn't mean manipulation in a simple sense. It means positioning. Large participants, hedging, accumulating, managing exposure, because silver is not just a metal. It sits at the intersection of industrial demand, investment demand, and monetary policy expectations. And right now, monetary policy is the biggest variable. The Federal Reserve has kept interest rates elevated. High rates reduce the appeal of non-yielding assets like silver. That's basic economics. But here's the contradiction. Despite high rates, despite tighter liquidity, silver is still holding, still reacting upward. Why? That's because inflation expectations haven't fully disappeared, because geopolitical uncertainty hasn't fully resolved, because markets are still pricing what could happen next. Just days ago, oil volatility, conflict risks, and currency shifts all played into expectations around inflation and central bank decisions. And when inflation expectations rise, precious metals tend to gain attention. But here's the twist. The Federal Reserve has not yet committed to aggressive rate cuts. And historically, silver needs liquidity expansion to sustain major rallies. So what you're seeing right now is not a full breakout. It's tension, 2 forces pulling in opposite directions. Tight monetary policy versus tightening supply. And when that happens, markets don't move smoothly. They snap. That's exactly what we just saw. Now think about this carefully. If banks or large players were trying to push prices lower, they would need liquidity. They would need sellers. They would need weak demand. But what happens when supply is already constrained and buyers step in unexpectedly? The move reverses. Fast, violently. That's not a theory. That's market mechanics. And here's your first curiosity trigger. What if this drop towards $78 was not a natural move, but a liquidity test? Because in many markets, large players test levels. They push price down to see if buyers appear. And if buyers absorb that pressure, the move fails. That's exactly what may have just happened. Now let's go one step deeper, because something else is quietly shifting. Investment demand. Coins, bars, ETFs, physical accumulation. These are not short-term trades. These are positioning moves. And even with some industrial slowdown globally, investment demand is increasing. That tells you something. The market is slowly shifting from industrial commodity to financial asset. And when that transition happens, volatility increases because expectations change. Silver is known for this. It is historically more volatile than gold because of its smaller market size and lower liquidity depth, which means moves can be exaggerated. And right now, we are seeing exactly that. Now pause, because this is where things get serious. You are entering a phase where traditional explanations start to fail, because if supply continues tightening and if central banks eventually shift toward easing even slightly, that combination could change the entire trajectory, but we are not there yet. Right now, we are in between a compression phase where pressure builds, but release hasn't happened. And when markets stay in this state, they become unstable. And instability creates opportunity, but also risk. So don't ignore this, because what just happened was not just a price move, it was a signal. And the question now is, was that the last failed attempt to push silver down? Or just the beginning of something bigger? Subscribe to the channel, like this video, and comment below. Because in the next part, we're going to break down what institutions, central banks, and liquidity flows may be signaling right now. And why this move might not be over yet. Now here's where things start to get uncomfortable. Because if you look at what just happened today and you remove the surface level explanation, a different picture starts to appear. Silver didn't just go up, it reacted. And reactions in markets usually come from pressure, not randomness. Let's go deeper, because right now, globally, the silver market is not balanced. It hasn't been for years. According to industry data, backed by institutions like the Silver Institute and Metals Focus, 2026 is expected to mark the 6th consecutive year of supply deficit. Not 1 year, not 2, 6 straight years. And this is critical, because deficits don't disappear overnight. They build tension. They reduce available inventory. They slowly remove flexibility from the system. Now combine that with what just happened in India. Imports paused, shipments stuck, supply temporarily restricted. Even Reuters confirmed that over 8 tons of silver were held at customs due to policy delays. That's not a small number. That's physical metal, not paper contracts. That's real supply, not speculation. So now think carefully. A market already running on tight supply suddenly loses access to incoming metal. And at the same time, price is pushed down towards 78.8. What should happen? Collapse. What actually happened? Reversal, that gap, that difference, that's where the real story is. And this is where most people stop thinking. They accept the headline, they move on. But if you're still here, pay attention, because this is where the mechanics start to matter. And before we go further, subscribe to the channel, like this video, and drop a comment right now if you think silver is being controlled or if this is just market structure, because what comes next might completely change how you see this move. Let's talk about liquidity, because everything comes back to liquidity. Liquidity is not just money. It's the ability to transact without moving price too much. And when liquidity is high, markets move smoothly. But when liquidity is tight, even small orders create large moves. Now think about current conditions. The Federal Reserve has kept rates elevated. That means liquidity in the system is restricted, money is expensive, risk-taking is reduced. At the same time, global markets are still dealing with volatility, geopolitical tensions, currency fluctuations, energy price shocks. All of this creates uncertainty, and uncertainty reduces liquidity even further. So now imagine a low liquidity environment with the supply-constrained asset facing sudden selling pressure. That's a fragile system, and fragile systems don't behave predictably. This is exactly what central banks and institutions study. Not just price, but stability. Because when markets become unstable, they can overshoot in both directions. That's why you're seeing these sharp moves, not gradual trends, but spikes, drops, reversals. And here's the part no one is clearly explaining. The Federal Reserve, the European Central Bank, even institutions like the IMF, they are all watching liquidity conditions very closely right now because inflation hasn't fully disappeared. Growth hasn't fully stabilized, and rate decisions are still uncertain. And this matters for silver because historically, silver reacts strongly to changes in liquidity expectations. When central banks ease, silver tends to rise. When they tighten, silver struggles. But right now, we are in between. Rates are high, but markets are already anticipating what comes next. That creates tension, and tension creates volatility. Now here's your first curiosity hook in this part. What happens when markets start pricing future rate cuts before they actually happen? Because that's when things move early, before confirmation, before headlines. And silver, historically, moves ahead of the curve. Now let's add another layer, investment demand. Even with industrial demand slowing slightly, investment demand is rising. Physical buying, bars, coins, long-term positioning. This is not short-term trading. This is accumulation. According to recent data, physical investment demand is expected to rise significantly, even as industrial demand softens. That creates imbalance because industrial demand fluctuates. But investment demand can accelerate quickly. And when it does, it pulls metal out of circulation, which reduces liquidity further. So now we have a setup, tight supply, restricted liquidity, rising investment demand, and uncertain monetary policy. That's not stable. That's explosive. Now here's your second curiosity hook. What if this move back to $80 wasn't the result of strength, but the result of something failing behind the scenes? Because in markets, failed moves are often more important than successful ones. A failed breakdown is often the first sign of a shift, and that's exactly what this looks like. Now let's zoom into today's move. Silver dropped towards 78. Pressure increased, selling intensified, and then buyers stepped in aggressively. Within hours, silver surged nearly 4 to 5%, touching around $82 again. That's not normal intraday behavior, not in a stable market. That's absorption, meaning someone was willing to buy everything that was being sold. And when that happens, price moves quickly. Now ask yourself this: who has the capacity to absorb that kind of volume? Not retail, not small traders. This is institutional scale, and institutions don't react randomly. They position, they anticipate, they manage exposure, and sometimes they defend levels. Now, this doesn't mean manipulation. Let's be clear. It means market structure, where large players operate within constraints, and when constraints tighten, their behavior becomes more visible. And that's what you're seeing. A market under pressure, showing cracks, but not where expected. Now, here's the critical point. If this was just a temporary move, price should fade again. But if this was a failed breakdown, then this level may become a base, and that changes everything. Because once a base forms, the next move is usually stronger, not guaranteed. But historically, that's how these setups evolve. So don't ignore this, because what you're watching right now is not just a price chart. Make sure you subscribe to the channel, like this video, and comment below. Do you think this was a failed crash attempt or just volatility? Because what you're about to hear next may completely change your expectations. Now step back for a second, because what you just saw in part 2, that reversal from 78.8 to 82, that was not just a local move. That was connected to a much bigger global system, because silver is not traded in isolation. It is deeply tied to currency markets, central bank policy, global liquidity, and geopolitical risk. And right now, all 4 of those are unstable. Let's start with what just happened globally today. Silver didn't rise alone. Gold moved. Other metals moved. This wasn't a random spike. It was part of a broader shift triggered by a weaker US dollar and changing expectations around inflation and interest rates. Now this matters, because when the dollar weakens, it signals something deeper. It suggests that markets are beginning to question how long can tight monetary policy continue? And that's where central banks come in. The Federal Reserve, the European Central Bank, even global institutions like the IMF, all operate based on one core principle: control inflation without breaking the system. But here's the problem. That balance is becoming harder to maintain because inflation pressures haven't fully disappeared and growth is slowing in key regions. That creates a dangerous scenario. If central banks keep rates high, they risk slowing the economy further. If they cut rates too early, they risk reigniting inflation. So what do? They wait. And that waiting period creates uncertainty. And uncertainty is exactly where silver starts behaving differently. Because silver doesn't wait for confirmation. It moves on expectations. Historically, silver has reacted early before major policy shifts. That's why what you're seeing right now matters. Because this may not be about today. It may be about what markets expect next. Now here's where things get even more intense. While all this is happening, the physical market is tightening. We already talked about India halting imports. But look deeper. India is not just another buyer. It is one of the largest consumers of silver globally. And according to Reuters, this halt left tons of silver stuck at customs, creating immediate supply disruptions. Now imagine this happening at the same time as a global supply deficit. That's not just tight, that's constrained. And constrained systems react violently. Now let's layer another reality on top. Investment demand. Even as industrial demand shows signs of slowing, investment demand for silver is rising. Coin demand, bar demand, physical accumulation. This is not speculative short-term trading. This is positioning. And historically, when investment demand increases, it removes supply from the market, which reduces liquidity further. And remember, low liquidity, so higher volatility. Now pause, because this is where everything starts to connect. A market with limited supply, rising investment demand, uncertain central bank policy, and tightening liquidity. That is not a stable system. That is a system under stress. Now let me ask you something. What happens when a stress system is pushed further? Because that's exactly what may have happened today. Silver was pushed lower towards $78. But instead of breaking, it reversed. That suggests something critical. The system resisted. And when systems resist pressure, it often means they are closer to breaking in the opposite direction. Now here's your first curiosity hook in this part. What if this wasn't a failed crash, but the first sign that downside control is weakening because markets don't stay controlled forever? At some point, pressure exceeds control. And when that happens, moves become explosive. Now let's talk about volatility. Silver is one of the most volatile major commodities. More than gold, more reactive, more sensitive to liquidity. And historically, when volatility increases, it signals instability. Not direction, but instability. And instability precedes large moves. Now connect this to what just happened today. Silver didn't just rise. It moved sharply. Quickly, aggressively. That's volatility expansion. and volatility expansion usually doesn't stop in one move. It continues. Now think about timing. This is happening right now, before the weekend, before global markets fully reset, before Monday's open. That matters because weekends create gaps, no liquidity, no intervention, no adjustment. And when markets reopen, they adjust instantly, sometimes violently. Now here's your second curiosity hook. What if this move toward $82 is not the end of the reaction, but the setup for what happens when markets reopen? Because historically, some of the biggest moves happen after periods of uncertainty. And right now, uncertainty is everywhere. Geopolitics, currency markets, interest rates, supply chains, all moving at the same time. Now here's the critical insight. If silver was truly weak, it would not have bounced like this. It would have continued falling. The fact that it didn't doesn't confirm a breakout, but it does suggest something underneath is stronger than expected. And that's where things become unpredictable, because markets can stay controlled until they can't. And when control slips, moves accelerate. Now don't misunderstand this. This does not guarantee a massive rally. It does not confirm any specific price target, but it does increase one thing: probability of volatility. And in volatile environments, opportunities and risks both increase. So don't ignore this, because what you're watching right now is not just a price movement, it's a shift in behavior. And behavioral shifts are where trends begin. Before we go into the final part, where we break down what could happen next, what levels matter, and why this weekend could be critical, make sure you subscribe to the channel, like this video, and comment below. Do you think this is just volatility or the start of something bigger? Because the final part is where everything comes together. Now, everything comes together, not theory, not speculation, but what is actually happening right now in the real market. Because what you just saw, that move from 78 to 82s, it wasn't isolated. It happened at the exact moment when multiple pressure points aligned. Let's reconstruct this step by step. Silver drops towards 78. At the same time, India, one of the largest buyers globally, halts imports. Banks stop placing orders. Metal gets stuck. Supply tightens instantly. At the same time, global markets are already dealing with high interest rates, restricted liquidity, uncertain inflation outlook. And then suddenly, silver reverses. Not slowly, not gradually, but sharply, aggressively, toward $82. Even Reuters confirmed silver jumped nearly 4.6% in a single move, reaching around $81.99. Now stop, because this is the moment most people miss. This is not just a rebound. This is a failed breakdown and failed breakdowns. Historically, change market direction, but here's where things get even more critical. Just as supply was tightening, pesticides, the Indian government suddenly stepped in and allowed banks again to import gold and silver. The restriction was lifted. 15 major banks authorized. Supply flow resumes. Now think about the timing. Supply was restricted. Price was pushed lower. Market didn't break. And just as tension peaked, supply reopening is announced. That's not just coincidence. That's a sequence. And sequences like this reveal stress inside the system. Because here's the reality. The global silver market is already in deficit. Not for 1 year, but for multiple years. Over 760 million ounces removed from inventories since 2021. And 2026 expected to extend that deficit further. That's not a temporary imbalance. That's structural. And structural imbalances do not resolve quietly. They build pressure. Now combine everything. Supply deficit, temporary supply shock, liquidity constraints, central bank uncertainty, rising investment demand. This is not a stable system. This is a system under compression. And compressed systems eventually release. But here's the key point. Release does not happen when people expect it. It happens when pressure exceeds control. Now ask yourself this. If the market was truly weak, why didn't it break below 78? If sellers were in full control, why did buyers absorb everything? If liquidity was strong, why did price move so violently? These are not random questions. These are signals. signals that something underneath is shifting. Now let's bring in central banks, because the Federal Reserve, the ECB, even global institutions like the IMF, they are all navigating the same problem. Inflation is not fully gone. Growth is not fully stable. Liquidity is already tight. And any decision they make next will impact markets immediately. If they stay tight, pressure continues. If they ease, liquidity returns. And when liquidity returns, assets like silver, historically, react fast. But right now, we are in the transition phase. Not tightening, not easing, waiting. And waiting periods are where markets become unpredictable, because expectations move faster than policy. And silver moves on expectations, not announcements. Now here's the final layer, timing. So this is happening right now, before the weekend, before global markets reopen, before liquidity returns, and weekends are dangerous in volatile markets because there is no trading, no adjustment, no reaction, only buildup. And when markets reopen, they adjust instantly, sometimes with gaps, sometimes with shocks. Now here's the final question. What if this move to 82 is not the reaction, but the warning? What if the real move hasn't happened yet? Because historically, when markets reject a breakdown, the next move is not small. It expands, not guaranteed, not certain, but possible. And in markets, possibility is everything. So don't ignore this, because what you just witnessed was not a normal move. It was a shift in behavior. And behavior shifts come before trend shifts. Before you leave, subscribe to the channel, like this video, and comment below. Do you think this was a failed crash or the start of something bigger? Because the next move may not give you time to react. And here's the cliffhanger you need to think about this weekend. If silver couldn't break at $78, even under pressure, then what happens when the pressure flips? And if that happens, will the system still hold, or will it finally lose control?